And good evening. We're doing it live right here, weeknights in the 5 o'clock hour and heart of drive time in Los Angeles. Mottek on Money, 5 nights a week for you, live on the air here in 790 KBC, streaming live online worldwide at kbc.com and the on-demand Mottek on Money podcast at kbc.com, Apple, iTunes, all your favorite podcast platforms, and on the socials too at Frank Mottek on X, formerly known as Twitter and Instagram. Stocks ending the day lower today, posting back-to-back losses now. Looks like the tech names that took a hit today. We've also seen crude oil prices hit the highest we've seen so far this year. Inflation on full display at Southern California gas pumps once again. Also news of deflation in China in focus on Wall Street, and we'll be getting new readings on inflation on this side of the pond tomorrow. The July Consumer Price Index will be coming out first thing in the morning. The Dow today down nearly 200 points. The S&P 500 down 32, and the Nasdaq slid 162 points. The inflation number out tomorrow, according to a Wall Street analyst polled by the Wall Street Journal. We're expecting the Consumer Price Index to rise 0.2% in July at the same pace from the previous month, and they also expect the annual rate of inflation to accelerate to 3.3% from 3% the previous month. And that so-called core inflation rate, the core which takes out the food and energy prices, expected to be up 0.2% in July. The core inflation rate over the past 12 months is expected to slow to 4.7 in July from 4.8 the previous month. That's still more than double the Fed's 2% target. China in focus today, with President Biden issuing an executive order directing the administration to implement new restrictions on U.S. investment in high-tech Chinese companies. On all things China tonight, I'll talk to the expert, China expert Gordon Chang, author of The Coming Collapse of China and the Great U.S.-China Tech War. He's on Twitter, too, at Gordon G. Chang. The hot labor summer continues here in Los Angeles. Some experts say the current strike in Hollywood could set a record for the longest writers' strike in Hollywood history. Back in 1988, the strike lasted 22 weeks, while the strike in 1960, which was the last time the writers and actors were both on strike, as we're seeing now, lasted 21 weeks. Looks like we're now in the 15th week. The current strike would surpass both of those records if it goes on until mid-October. We'll talk about what's happening with the dual writers and actors union strikes having a huge financial impact on the local economy, shutting down Hollywood movie and TV production. Meanwhile, there is a new economic engine in town. Her name is Taylor Swift. Swifties from all over the world have come to L.A. over the past week to catch Taylor Swift concerts at SoFi Stadium, pumping millions into the local economy. I'll discuss what's happening here with prominent Los Angeles economist Dr. Robert KLEINHENZ, principal at KLEINHENZ Economics. But first, on the markets, your money, the economy. Joining us live now, money manager Ken WINANS, president of WINANS Investments, Forbes magazine contributor, and author of Investment Atlas 1 and 2. Ken, thank you very much for taking the call. We've had a bit of a rough patch this week on Wall Street, and now the big inflation number coming out tomorrow. Give us your view of things here at the moment.
Frank, before I get started, I just want to talk about, you mentioned Taylor Swift, and I was in Pittsburgh, Pennsylvania earlier this year, and I will tell you it was amazing to see all these young, well-dressed young ladies going to her concert in their best gowns and gala outfits. It was fantastic to see everybody dressing up again. And also a little tidbit of knowledge on Taylor Swift. Her father was a stockbroker in Philadelphia, so she comes from a Wall Street family. But let's talk about what's going on in the markets. Frank, this market, in my opinion, climbed way too far, way too fast, and it was led by a handful of, big tech companies that had a tremendous sway on the market benchmarks. Here's my problem. I know that bull markets, as we would define them historically, do not start and certainly are not sustainable when you have a contraction of credit and higher interest rates. And one of the key pieces of information that came out earlier this week was the downgrade in ratings of regional banks. And one of the big concerns that was in that report was that they were not going to be lending as much because of tighter credit. So again, we're in a very funny world. It doesn't mean you leave your cash on the sidelines. It doesn't mean that you run for the hills, but you have to be very, very smart. And what if I am right and this market is largely going to be trading in a big sideways channel for the next 3 to 5 years, and we've seen the highs and the lows? You just need to think, what if I'm right, and how do you play it? That's really all you have to really think about.
If Taylor Swift is listening, she's probably tuning in for the stock market report that'll be coming up very, very shortly. So Taylor may be on the way to SoFi Stadium tonight from Beverly Hills. So we want to welcome Taylor Swift and all of her fans to this program this evening. Now, Ken, let me ask you this regarding this downgrade of the banks. Moody's, as you mentioned, cut credit ratings of several small to mid-sized banks this week and said it may downgrade some of the nation's largest lenders, warning that the sector's credit strength will likely be tested by funding risks and weaker profitability. This is after Fitch downgraded the Uncle Sam's credit rating, as well as the credit rating for Fannie and Freddie, the mortgage giants. What's going on here with all these downgrades, and what do they see that others are not?
Well, here's the thing. Historically, when you have credit contraction, which, by the way, you cannot have credit expanding all the time. We went into a spending binge over this century at all levels, corporate, government, at all levels. So we're having that very much needed readjustment. In fact, I was telling a reporter today that they said, King for a day, where did things go wrong? And it's my opinion that the Federal Reserve should have been raising interest rates 2010, 2011. They should have been coming off of zero then, but there was tremendous political pressure to keep the pedal to the metal and spend money. So we have that situation that we're now paying a dear price for. But Frank, it's all the same thing. Credit is going to be very uneven going forward, and I see it particularly in corporate bond yields. Companies that are more cyclical, that means they don't make money, they don't all the time, they don't have constant growth, are going to be spending a lot more money to borrow than some company that actually doesn't even need to borrow money. So we're back in that very strange conundrum that we saw many, many decades ago. But with that being said, let's also not forget seasonality. This time of year, basically August going into September, in all my years of managing money, I don't have real fond memories, especially of September. It's usually a typical pullback month. So it is important that people begin to say, well, I'm going to rebalance my portfolio. I've made a big chunk of money on the bounce back in tech stocks, and I'm going to begin to rebalance. It's not a time to sit on your hands. It's a time to actually think about going through the rest of this year and how to, basically reposition for the next change in leadership, which I think will be coming in the fall.
Very interesting. The Fed throttled back its recession expectations. Some of the major banks have come out with statements saying they now do not expect a recession. But it's interesting to note that Moody's, in its downgrade of the banks, said this coming as a mild U.S. recession is on the horizon for early 2024, and asset quality looks set to decline, with particular risks in some banks' commercial real estate portfolios. There's that commercial real estate concern being expressed again. What about your outlook for where things go from here?
I'm going to call it the big S, and I'm not talking about Superman. I'm talking about stagflation. You simply are not going to have any real growth overall in the U.S. economy, and in some parts of the country, it will be negative growth for the foreseeable future. When you have inflation running at 4% and the economy is growing at 3.2, let's say, you don't have real growth. So we're going to continue to have to deal with that going forward. And Frank, it's funny because most people who were not around to remember, we have backed away from the very high inflation levels that we saw a year and a half ago. But I think two things that are so critically important for everybody in the audience to think about: inflation doesn't go straight up and straight down. Think of waves on the beach. It has ebbs and flows. And getting down to the Fed's target of 2% is going to be very, very hard to get that last 1.8% out of the system. And by the way, I support the Fed doing that. Inflation in the long term is very corrosive. It is not good for the economy. It's not good for savings. So we're just going to have a little bit more pain to try to get it back to balance. But again, we're not talking months here. We're talking it could be up to a year to completely correct this.
In the meantime, the price of oil has hit a new high for the year, getting close to $90 a barrel again, and prices at Southern California gas pumps well above $5 a gallon on average, $5.16. I see now the regular average price, $5.50. The average price for premium, well off the highs we saw last October, but still pretty painful here at the pump. Those numbers are going in a wrong direction here.
Well, it's not unusual to have oil and gas prices climb during the summertime just because we use more oil during vacation time, and we are still in the midst of that. But let's also not forget that a lot of oil is very political, meaning they tax it and they also regulate heavily how it's produced and how it's transported. So, again, those two hands are at work with this. And I would just simply tell everybody that it's a lot better than it was last summer when you and I did a show then, and it was eye-popping what we were all paying at the pump. But, again, it's not going to go – it certainly is playing the seasonal norms. Now, what I would tell everybody, my bigger concern is going to go into wintertime, fall and wintertime. I think we're going to see natural gas prices really spike going into the wintertime. So, as an old commodity guy, I try to look ahead a little bit and try to get to, prepared for what's going on. But again, Frank, we're just talking about, we're in this tug of war, earnings, interest rates, geopolitical stuff, and it's always tugging around, and it gets to be kind of this herky-jerky thing that causes investors to pull hair. The worst thing you can do is overtrade, and the worst thing you can do is trying to anticipate or think things are going to go back to the way they were, over the last 30 years, and they're simply not. You need to be more proactive with your managers on how you invest your money.
All right, what about NVIDIA, which has seen a pullback from its recent high? Let's see, down, in fact, $21 today, back to $4.25 on that AI craze that popped up earlier this year. What about AI and NVIDIA here at this point?
Well, if anybody feels like they missed the AI bump initially, the old adage, buy when there's blood in the streets, and excuse the pun, but it does mean that when the news is starting to turn bad, that's when a lot of people step in and start buying. You're supposed to buy on pullbacks, and nothing runs straight up forever, but I would caution everybody to remember that NVIDIA and the other AI stocks got absolutely creamed in 2022. They're very volatile, and they are not for everybody. And I think that there's other tech plays that you can look at, certainly in the IT space, that are not as volatile but will certainly give you a nice performance in your portfolio.
All right, what about Apple? Looks like there's buzz here again that Apple might buy Disney. What are you picking up on that?
Oh, man. Frank, how many times have you and I talked about who's going to be buying Disney?
20 or 30 years at least.
Yeah, exactly. And it's sad because you see this great old company, especially as such an important component of Southern California and certainly in Florida, running its course for a lot of the wrong reasons, which is, political content and, getting involved with, governors and all kinds of stuff. And I'm not trying to make political comments here, but companies' jobs are to make money for their shareholders and certainly to do it under the guidelines of government regulations. And it's sad that it's happened to Disney like that. Here's the thing. My question would be, and I am by no means an expert on Apple corporate strategy, but I'm not all that sure it makes sense for Apple to buy Disney versus just set a whole bunch of very strong alliances with it going forward. Because we do know, like the numbers came out today on Disney, and the age-old problem is the subscriber base is dropping. Conventional TV watchers are dropping. They're moving to streaming, and Disney and the other conventional companies are having a tough time with this. So I'm not sure that fits what Apple would want to do, which is more new age type stuff.
Mix a little sports analysis, pop culture, and great interviews, and you've got the Rich Eisen Show podcast.
The Jets are bracing themselves into doing Hard Knocks this year.
Bracing themselves. Look, coaches want to control the controllables. They don't want to have a camera crew in the building. I know that they want to lie low. This is what happens when you go and swing for the fences and get Aaron Rodgers. Are you kidding me?
The Rich Eisen Show podcast, wherever you listen.
Technology stuff, but we'll have to see. But rumors abound, my friend. They always do.
Right. The headlines, a long simmering rumor of Apple buying Disney resurfacing as Bob Iger looks to sell assets. Disney posting a smaller streaming loss will hike prices for Disney Plus and Hulu. And Disney also raising prices on Hulu and Disney Plus again. And looks like Disney getting into gambling with ESPN. So a lot going on there at Disney based on what we heard here today. What about Disney stock at this point?
Well, it's funny you talk about gaming because one of the great unsung scenarios that's playing out in Las Vegas, and everybody's forgetting about this, when the Golden Knights won the Stanley Cup, yes, the city was happy. We had the parade, the Stanley Cup's there, but where the real money was made was in gambling. And the same bet's being made about NFL, the same bet's being made about the proposed move of the A's to certainly to Las Vegas and possibly getting an NBA team. But it's about the gaming, Frank, and that And what you're seeing there is going to be a continuing trend going forward that I think is going to be a positive for a lot of these companies. And we'll just have to see how it plays out. But here's the thing. I do know for a fact, you and I both know people who are long-term employees at Disney at all levels, especially on the media side. And I can tell you for a fact, as I've talked to a lot of these people who I know personally, they are looking to change jobs. They've had enough. They've gotten creamed on their stock options. They're mad what's happened, and they're looking at making changes. And I think that brain drain could further cause problems for Disney.
All right, and speaking of what many consider gambling, cryptos here, Ken, what are your thoughts about how the cryptos have held up this year? Bitcoin just below 30,000 here at the moment. What are your thoughts about what you're seeing in the crypto space?
I think that, here's the thing. Crypto is a tough one because and every money manager has to go through the changes in how we look at money and how we invest money. I battle people all the time on this. It is not a currency. In fact, I finally won some converts over to tell them, look, by all means, trade Bitcoin, trade the other cryptos, but also think about trading more, conventional fiat currencies as well. And I've actually had people say, yeah, I need to learn how to do that. Here's the thing. It correlates very, very closely to what happens in high tech. And as long as you have that correlation, just simply watch what's going on with the NASDAQ and the NASDAQ 100. And I think you'll pretty well see what will happen with Bitcoin going forward. Personally, I think everybody should consider who has big concentrations of their portfolio in Bitcoin, think about just simply acknowledging you've had a wonderful dead cat bounce after what happened last year, and you might want to think about rebalancing your portfolio. There's no need to go through that again if it does in fact happen, but balance it into ways that will, still make you money, but will be maybe a little bit less volatile for most people. And obviously, I'm still a big fan of just plain commodities. I mean, look what's going on with gold right now. Gold is moving back up as well. So I think that there's places for the crypto people to go besides just staying in a one-trick pony.
All right, and before we let you off the hook here, Ken, where are you putting money now and/or taking it off the table?
All right, I'm going to give you one of my first big predictions for the fall. Healthcare has had a very, very rough time this year, and for a lot of different reasons. And I think there's going to be a leadership shift going into the fall where tech is not going to be the main driving group. You're going to see the market beginning to broad out. But just a couple of names that caught my eye as I went through earnings season. One of them is McKesson, symbol MCK. The other one is a company called Vertex Pharmaceutical Health, symbol VRTX. These, again, I'm just agnostic about the companies. These are two companies that posted good earnings, and the stock is performing well. Two other quick names. I still like the automotive play on the retail side. It's just one of the few areas where retail is really clicking along because if you think about it, people are going to run down to a store to buy windshield wipers or fluid for their car versus buying it on Amazon. The name that comes out in my mind is O'Reilly Automotive, symbol ORLY. And then, Frank, I'll guarantee a name that you probably have never heard of before, but it is one of the best performing stocks over the long term in the S&P 500. It is called Implied Industrial Technology, symbol AIT, and it's a distributor of industrial products. It's as boring as they come, but the stock is flying, and so I'm trying to give the audience some new names that most people are not even thinking about, but those are my picks for the night.
Terrific, Ken. Thank you very much for taking the call here. That is Money Manager Ken WINANS, president of WINANS Investments, Forbes magazine contributor, and author of Investment Atlas 1 and 2, market historian. Ken, thank you very much for joining us here this evening, and wish you a wonderful evening.
You too, Frank. Good night.
Thanks again. Friends, does your knee pain keep getting worse? How about that pain in your shoulder or hip or back? Don't let them tell you steroids and surgery are your only options. Take my advice now and call QC Kinetics. Frank Mottek here. QC Kinetics can make that pain go away with an all-natural advanced regenerative treatment. They're helping people here and every day with these amazing natural treatments that restore and repair damaged joint tissue. It's like turning back the clock. Regenerative medicine uses concentrated healing agents from your very own body to stimulate that damaged tissue in your joints so they can work like they're supposed to, and there is zero downtime. QC Kinetics is the nation's leader in this exciting medical breakthrough. Patients here are getting real, lasting relief and are saying no to surgery and drugs. Now, if you're in pain due to injury or arthritis, this is a remarkable option that you need to check out, and the consultation is free. Call QC Kinetics, locations in Glendale, the city of Orange, Mission Viejo, and now also in Costa Mesa. Call 213-997-PAIN. 213-997-PAIN. Again, that's 213-997-PAIN. 790 KBC welcomes, you guessed it, the Gypsy Kings. Featuring Nicholas Reyes, coming to the Greek Theater August 12th. Tickets are on sale now at Ticketmaster.com. Right now, caller 9 wins right here at 1-888-790-5222. You can get a pair of tickets to the show. If you're caller 9, call now, 1-888-790-5222 for a pair of tickets to the Gypsy Kings coming to the Greek Theater on August 12th. Mottek on Money continues here in 790 KBC. Pullback for the stock market again today with the Dow down 191 points, settling at 35,123. The S&P 500 down 32 at 4,468. And the NASDAQ down 162 at 13,722. The yield on the 10-year note has eased a bit to 4.01%. That's the one that impacts the fixed-rate mortgage rates out there. Price of gold down $1.20 at $1,949.40 an ounce. The price of oil kissing a new high for the year, hit as high as $84.40 a barrel in New York. In London, which is the international benchmark, Brent crude in London up $1.38 at $87.55 a barrel. The damage continues to be done at Southern California gas pumps, where we're looking at $5.16. The average price for regular now, premium averaging $5.50 a gallon, and diesel now at $5.62 a gallon in the L.A. Long Beach area, according to the latest AAA Fuel Gauge survey. Apple pulling back today, down $1.61 at $178.19. Disney also moving lower. NVIDIA shares down more than $21 at $425 and change. Taking a look at the cryptos, Bitcoin up $1.32 at $29,635. Ethereum up 4 at $1,856, and Doge at 7 cents. Mottek on Money continues here in 790 KBC. Good evening. Big news out of China impacting our economy here. China's consumer sector falling into deflation and factory gate prices extending declines last month. The world's second largest economy now struggling to revive demand and pressure mounting on China to release more direct policy stimulus. Meanwhile, President Biden today signing an order that will prohibit some new U.S. investment in China in sensitive technologies like computer chips and require government notification in other tech sectors. Now, this long-awaited order today authorizes the U.S. Treasury Secretary to prohibit or restrict American investments in Chinese entities in 3 sectors: semiconductors and microelectronics, quantum information technologies, and certain artificial intelligence systems. The order aimed at preventing American capital and expertise from helping China develop technologies that could support its military and undermine U.S. national security. The measure targets private equity, venture capital, joint ventures, and greenfield investments. Now, we did hear today from Charles Schumer, the Senate Democratic leader. He said for too long, American money has helped fuel the Chinese military's rise. In his words, today the U.S., he says, is taking a strategic first step to ensure American investment does not go to fund Chinese military advancement. Republicans said today's order was rife with loopholes, such as only applying to future investment, and was not aggressive enough. Following all these developments now, China expert Gordon Chang, author of The Coming Collapse of China and the Great U.S.-China Tech War, and he's on Twitter, too, at Gordon G. Chang. Gordon Chang, thank you very much for taking the call. First of all, on this Biden executive order, give us your reaction to that big news here today.
The thing about the executive order is that it only will apply in the future. It has a 45-day comment period. And through various rounds of consultations, nobody's expecting any rules until next year. And President Biden, when he issued this executive order today, said that he was declaring a national emergency. But the order doesn't really seem to fit with that because there's a certain lack of urgency in the rules.
We did hear from Republican Senator Marco Rubio, who called this Biden administration plan almost laughable, riddled with loopholes, explicitly ignoring the dual-use nature of important technologies and failing to include industries China's government deems critical. So what are your thoughts on that?
Yeah, the most important loophole in all of this, apart from the fact that it doesn't apply now, is that China has no civil military distinction, which we Americans have, and which is the basis of this order. Because under the doctrine of military-civil fusion in China, everything that a civilian institution has is available to the Chinese military. So you can't really have a little bit of investment in China because it'll go pipeline directly to the military. I mean, we have to look through this order. I mean, it's going to be watered down in all probability. The Chinese government said it was, quote unquote, very disappointed, but I think they're probably pretty happy with this order.
Certainly, California and China, very big business between these two places. And the Chinese tech industry, I understand, has already seen a drastic decline in U.S. investment with this intensifying tension we've seen between the U.S. and China in recent years. Last year, we see total U.S.-based venture capital investment in China plummeted to $9.7 billion from nearly $33 billion in 2021. What do you see ahead for this and the business connections that we've seen, especially here between California and China?
Well, for instance, Sequoia split itself off into China and non-China portions. And I think that that's a realization of the tensions between Beijing and Washington. You referred to the PitchBook data. I think that probably we're going to see further declines in all of this because companies are starting to understand that they're having to make a choice. Of course, they don't want to, but China is forcing them to make a choice, and the Biden administration belatedly will force them to make a choice as well.
New concerns about the Chinese economy this week, which rattled the global markets, and new worries about a global slowdown. What do you make of what's happening there now?
Well, the price data that we just saw a few hours ago was really distressing. China is now in deflation. You have both the producer price index and the consumer price index flashing negative. But what was really distressing was the trade data yesterday, which showed that exports were down 4.5% year on year last month. And even more important, imports were down 12.4%, and imports were down in July for the 10th straight month. Because imports are perhaps the best underlying indicator of domestic demand, in other words, the economy itself, I think China's probably contracting right now. And because Xi Jinping is applying all the wrong policies, I don't see any escape for China.
And we've seen more military moves. You might have seen that report that the Chinese Navy water cannoned a Philippine military ship in the South China Sea. Any more fallout from that incident?
The fallout is that countries are starting to notice. The Chinese have been doing this a long time at Second Thomas Shoal, where this incident occurred in the South China Sea. What people haven't noticed is that for at least the third time in the Biden administration, the State Department has issued a formal notice to China reminding them that we have a mutual defense treaty with the Philippines, and that covers Philippine craft. In other words, that's a warning to use force. I'm sure the Biden administration, of course, did not want to have to issue that, but China's leaving the Philippines with no choice because Beijing is ramping up its pressure on the Philippines with its demands. And also, China's propaganda has now become more vicious, outright lying. And so this is getting to be very serious.
That happened this week, and then you have Taiwan reporting a second large-scale China Air Force incursion this week. What's happening there?
Well, they had about 10 planes approach and enter Taiwan's air defense identification zone. At the same time, you had Chinese vessels approaching Taiwan. I'm not as concerned about Taiwan as I am concerned about the Philippines. And the reason is that Taiwan has a presidential election on January 13th of next year. And it doesn't really help for China to ramp up military pressure because that is counterproductive, I think, for what China wants to see in terms of the electoral outcomes. Right now, I think there's going to be a lot of huffing and puffing. It could get dangerous, but I'm much more concerned about what's occurring in the South China Sea than I'm worried about what's occurring with regard to Taiwan.
And while this is happening, another report says China's military has undergone its biggest leadership shakeup in a decade after two top generals overseeing the country's nuclear arsenal vanished from public view. What are we to make of that?
Xi Jinping, of course, wants to reassert control, which apparently he doesn't have. But even more worrisome is that we know that this year he's been purging general officers who are opposed to go to war. And I think that probably this purge of the commander and the political commissar of the rocket force was a part of that purge to make sure that the military will fight.
the problem here is that this is the section of the branch of the Chinese military that controls nuclear weapons, as you just pointed out, which means that Xi Jinping is probably thinking that he will threaten the use of nukes to prevent the United States and others from coming to Taiwan's aid, and also that he might actually use them. So this is ominous.
Gordon Chang, thank you very much for that important update here tonight, and look forward to speaking with you again very soon.
Thank you, Frank.
That is China expert Gordon Chang, the author of The Coming Collapse of China and the Great U.S.-China Tech War. And he's on Twitter at Gordon G. Chang, live with us here tonight on Mottek on Money on 790 KBC. It is jarring to have a car accident and hard to think clearly when you're hurt. So my friend, attorney Clark Fielding of Fielding Law, has created something to help you. It's a guide called Be Prepared Before a Motor Vehicle Accident. The guide is one page, fits right there in your glove compartment, gives you everything you need in case you're hurt in an accident. Go to ClarkTheSharkLaw.com and download your free one-page guide and keep it right there in the glove box and put Clark Fielding's number in your phone under the word accident. So all you have to do is hit the number when you need him. Tell your family and friends to do the same. So if you're hurt in an accident, call the one we all trust, attorney Clark Fielding. The number to call, 833-88-SHARK. That's 833-88-SHARK, 833-88-SHARK, and download the Be Prepared Before a Motor Vehicle Accident Guide at ClarkTheSharkLaw.com. Again, that's ClarkTheSharkLaw.com. Mottek on Money continues here in 790 KBC. The dual writers and actors union strikes having a huge financial impact on the economy, shutting down Hollywood movie and TV production. Somebody got the calculator out and shows Hollywood strikes have had about a $3 billion impact on the California economy. Meanwhile, Taylor Swift has become an economic engine here over the past week in the Los Angeles area, with Swifties from all over the world coming to catch her shows at SoFi Stadium. Keeping track of all of this, prominent Los Angeles economist Dr. Robert KLEINHENZ, principal at KLEINHENZ Economics. Dr. KLEINHENZ, thank you very much for taking the call. It's been a while since we chatted behind live microphones. First of all, on this hot labor summer, give us your assessment of what's going on here.
Thanks for having me on, Frank. It's great to be on today. Yes, it's been probably a surprisingly strong labor market that we've seen this summer. And then on top of that, we've had, one strike after another or labor action. So it's been a very busy summer. I'll just say, that the U.S. economy, the unemployment rate for the U.S. economy is at 3.6%. That's pretty good. There are a lot of reasons to look at the economic news and say, well, I can understand now why economists are calling off the recession predictions and perhaps waiting until next year to anticipate a slowdown or even a slight contraction. But so the labor market's hot. We still have more job openings than we have unemployed persons at the local level. The LA County economy added jobs at about twice the usual pace in June. So those are good pieces of news, but of course it's happening against the backdrop of what's happening with Hollywood and the strike there, the LA City workers yesterday, and those are just a couple of actions that have happened recently.
Right, and of course then the hotel workers strike as well, and even healthcare workers, with obviously the cost of living being what it is here, people demanding more pay and consideration here. We haven't seen anything like this as far as a city strike since, 1980? And this dual writers and actors strike, haven't seen anything like that since 1960. So some pretty amazing things happening here. Is this going to push us into a recession faster than most people expect? It should be noted Moody's thinks a mild recession is still on the horizon for early next year. Give us your assessment of all that.
Yeah, so with regard to the prediction of recession, it does seem as though the big shops who do forecasting of economic activity are saying that the first half of next year is going to be soft, if not a recession. So that's a possibility. But we had a false positive at the beginning of 2022. Here we are in 2023 calling off the recession. I think we're still dealing with the hangover effects of the pandemic, not to mention perhaps some other forces, long-term demographic forces. As for the strikes that you referred to, you've been reporting for a long time the cost of living being so high here in Southern California and in all of California. It's a big challenge for many households. For the typical household, it's a big challenge. And, just as an example, the median home price for a single-family home in Los Angeles in the first quarter of this year was $746,000. A household required $180,000 to be able to afford to buy that house, to make the monthly payments on the house. But the average household income is about $80,000. So this is not a new story. The strikes are, but it's a response to this. And, we've seen sort of a cause and effect that the high cost of housing and more generally the high cost of living has been a triggering event that has driven people to relocate, whether it's to leave Los Angeles County and move to adjacent counties inland, or maybe to leave the state. So this is a real problem. There's a bigger picture. If you take a look at the share of the economic pie that's gone to workers over the last few decades across the nation, it's become smaller and smaller. So I can understand how difficult it is for households to be able to afford to live here in Southern California, and this is the response.
Right. What do you see happening in real estate? Your illustrious background includes having served as Deputy Chief Economist for the California Association of Realtors and Chief Economist of the LAEDC, and we've been talking for many, many years. Dr. Kleinhenz, give us your assessment of what you see happening in residential as well as commercial real estate, which remains a big concern nowadays.
Yeah, so with respect to housing, if we look at the existing home prices that were reported not too long ago by the California Association of Realtors, LA County's housing median home price in June was $832,000. In Orange County, $1.26 million, and then it's somewhat lower in the Inland Empire. But usually we look for bounces in home prices from March through June, and that kind of happened in the sense that LA saw a 12% increase from May to June. But other parts of Southern California saw home prices kind of flat from month to month. Year over year, as I think many of your listeners know, home prices have been falling. Not a lot. They've been down. Well, the median price for LA County, for example, is down 3%. It's on the sales side that things have dropped off quite a bit, down about 20% year over year for LA County. And that stems from, of course, low affordability, attributable in part to the increase in interest rates over the last few years. And we continue to look at extremely low inventory of homes for sale. Really hasn't budged from about 2 months over the last several years. And that's what we're looking at right now. An unsold inventory index of 2 months inventory is low by any measure. So not a lot of supply out there. New home construction is also weak relative to last year. It's down about 8% in the metro area. So housing continues to be a difficult story to tell. I would just point out that the high interest rates have become a barrier, if you will, to people being able to qualify. But people who are able to qualify at higher rates, have had to rethink what they can afford and what they will go ahead and buy. So it's not like the housing market has completely hit a standstill. It's moving forward, but at a much lower volume.
And I'm sure I'll be talking about this tomorrow at the State of LA business event. The Chamber is putting on Taylor Swift, a big star for the economy here, about a $320 million bump to the LA economy because of the concerts here. Just anecdotally, are you seeing the Swiftie impact here on the economy?
So I am not a Swiftie. I guess I'm embarrassed to say that. I think it's remarkable that, one event, or I should say, one entertainer, of course, having a several-day stint here at SoFi Stadium, has been able to cause an economic impact, as you mentioned. So that's very remarkable. We just want to keep in mind that when you take a look at the metro area, it's a huge metro area. So how do we put those numbers into perspective? GDP in LA County in 2021 was $840 billion. You roll in Orange County, our regional economic activity was in the neighborhood of $1 trillion.
That's pretty amazing. Well, Taylor Swift definitely helping to shake off any recession here. So we have Taylor Swift to thank here at the moment. Dr. Robert Kleinhenz, prominent economist, principal of Kleinhenz Economics. Thank you very much, Robert, for taking the call live with us here tonight. And I'll be back again tomorrow evening, the 5 o'clock hour. Mottek on Money on 790 KBC.